If you have been following Yang Zhejiang Shipbuilding, you would have heard of the news that it is buying a Singapore office building for around $400 million. So in this video, we're going to dive into the news, whether this is a bad move or not, also touch on Yang Zhejiang's financial numbers, valuation, and what to look out for in the stock. But before that, okay, do help us smash the like button and subscribe to our channel for the algorithm to do its work and for you to enjoy more interesting stock ideas videos like this. Okay, in return, I will share with you a financial meme which I actually copied from SGAG this time around. Okay, back to the video. Let's address the elephant news in the room. So Yang Zhejiang is buying an office building in the CBD area. And according to their press release, the purchase is fully funded by their internal cash reserves. And the freehold property is expected to provide an inflation hedge and stable cash flow. On top of that, right, the building will be managed by a professional real estate manager. For those who are afraid that Yang Zhejiang is making a wrong move by going to the real estate sector, the CEO is quick to come out, and alleviate our concerns by saying this. Okay, this is Yang Zhejiang chance to have their very own office building and a good vehicle to preserve their existing capital and also earn rental income in the same time, given the high inflation environment. He also emphasized that this is a one-off exercise and their focus remains in the core shipbuilding business. All right, so a professional real estate manager will be appointed to manage the building. So if you were to ask me, right, from my own personal opinion, Yang Zhejiang, this move is quite wise in the sense that they have a lot of cash sitting around, more than their total debt incurred as of first half 2022. In fact, if you look at the picture over here, when we minus the total debt from the total cash and cash equivalent, Yang Zhejiang is in a net cash position of renminbi $3.7 billion, or around Sing dollar $715 million. More than enough to just buy up the whole building already. Alright. So next, let's move on to Simply Wall Street, right, where we will touch on the financial analysis. So when we look at the sales and the earnings trend before COVID happened, right, before 2020, we can see that sales are on the uptick, all right, but earnings are still relatively flat and didn't really follow suit. Okay, and if you were to factor in the free cash flow, all right, we can see that it's actually fluctuating wildly over the past 6 to 7 years. And this gives me the sensing that the company probably has to pump in a lot of capital expenditure to maintain these business operations. Okay, but on the bright side, right, we can see that from June 2021, all right, things are getting better. The sales are getting a rebound, all right, and the earnings and free cash flow are coming back as well. Okay, next, let's touch on the management team. As for the management team, the company was actually founded by the CEO's dad, Ren Yuanling, but he has since left the company under his son's good hands in April 2020. In fact, I'm pleasantly surprised by the interview article I read, whereby Ren Yuanling actually praised his son of being humble and pragmatic, very different from those typical Fu type. Okay, and the current executive chairman and CEO Ren Le-Tian greatest strength was actually have to be him working from the bottom ranks of the company when he joined the group as a site project manager in year 2006. Okay? Since then, he has assumed many managerial roles at very different levels and divisions of the company before becoming the current CEO. If you want to read more about the interview, you can actually check out the link in my description below. And not forgetting about their insider ownership, we can see that the management team is well aligned with the shareholders because the CEO owns a 4.2% personal stake, while the founder or his dad owns another 21.6% interest via his Julius Baer Trust. And for Yang Zijiang's peer valuation, okay, we actually compare it to global shipbuilding peers based on the PB ratios. So over here, we can go to the PB ratio. I've already pre-selected a few, shipbuilding companies. Okay, we have this Fincantieri, all right, is a Italy firm. All right, we also have STX from Korea, Hyundai Heavy Industries from Korea, as well as another China peer, which is China Shipbuilding Industry. Okay, and if you were to compare, the five of them, I would say that Yang Zijiang is more or less, fairly valued. Okay, although when you based on the peer average of 1.9 times, it is slightly undervalued. Okay, and okay, so if you were to look at the analyst growth price targets, there are currently seven analysts covering Yang Zijiang. All right, and they have average 1 year target price of $1.56. So that's a good around 30% potential upside from the current share price. And last but not least, all right, the growth prospects seem to be bright for Yang Zijiang. Firstly, Yang Zijiang's pivot towards the cleaner LNG vessels may help them to be in line with the Chinese government green policies and also attract interest from many different, those big ESG funds. And next, okay, according to UOB Kay Hian analyst report, Yang Zijiang has been securing many new contracts on a regular basis. On top of that, right, Yang Zijiang also boasts a record high order backlog of more than 11 billion US dollars, which will potentially secure their earnings visibility through the year 2026. Okay, to end off, if you want me to cover any other blue chip stock, be it Singapore or US stock, let me know in the comments down below. Next up, you can also check out this video of 5 defensive Singapore stocks with at least 4% dividend yields. With that, I will see you next time. Thanks for watching and ciao.